Credit card interest rates are the fees that you pay for borrowing money from your card issuer. They can vary depending on several factors, such as your credit score, the type of card you have, and the market conditions. One of the most important factors that affects your credit card interest rate is your annual percentage rate or APR. This is the yearly cost of borrowing money expressed as a percentage. Your APR can be fixed or variable, depending on whether it changes with the prime rate or not. Your APR is not the same as your daily interest rate, which is the rate that applies to your balance every day. To find your daily interest rate, you need to divide your APR by 365 days. For example, if your APR is 20%, your daily interest rate is 0.055%. Another factor that affects your credit card interest rate is your average daily balance. This is the sum of your balances for each day in a billing cycle divided by the number of days in that cycle. For example, if you had a balance of $100 for 10 days and $200 for 20 days in a 30-day cycle, your average daily balance would be $166. To calculate how much interest you will pay in a billing cycle, you need to multiply your average daily balance by your daily interest rate and by the number of days in that cycle. For example, if your average daily balance is $166.67, your daily interest rate is 0.055%, and your billing cycle is 30 days, you will pay $2.75 in interest. Credit card interest rates can vary so much because they depend on many factors that can change over time. For example, if your credit score improves or worsens, your card issuer may adjust your APR accordingly. If the prime rate goes up or down, your variable APR may follow suit. If you switch to a different type of card, such as a rewards card or a balance transfer card, you may get a different APR as well. Credit card interest rates can have a significant impact on how much you pay for using your card and how long it takes you to pay off your debt. Therefore, it is important to understand how they are calculated and why they can vary so much. One of the best ways to avoid paying high interest rates on your credit card debt is to use balance transfers, debt consolidation, or other strategies to lower your interest rate and pay off your debt faster. In this section, we will explain what these strategies are and how they can help you save money and get out of debt sooner. Balance transfers involve moving your existing credit card debt to a new card that offers a lower or 0% APR for a limited time, usually from 15 to 21 months. This way, you can avoid paying interest on your balance while you pay it off. However, balance transfers usually come with a fee, typically 3% to 5% of the amount transferred. You also need to have good to excellent credit to qualify for the best balance transfer offers. And you need to pay off your balance before the promotional period ends, otherwise you will be charged the regular interest rate on the remaining balance. Debt consolidation loans are personal loans that you use to pay off multiple debts, such as credit cards, medical bills, payday loans, or other personal loans. You then make one monthly payment to the lender until you repay the loan. Debt consolidation loans can have lower interest rates than credit cards, especially if you have good to excellent credit. They also have fixed repayment terms, usually from 1 to 7 years, so you know exactly when you will be debt-free. However, debt consolidation loans may have origination fees or prepayment penalties. You also need to make sure that the loan payment is affordable and that you don't rack up more debt on your credit cards after paying them off with the loan. Other strategies to lower your interest rate and pay off your debt faster include negotiating with your creditors for a lower interest rate or a hardship plan. This may help you reduce your monthly payments and save money on interest. However, this may affect your credit score or limit your access to credit in the future. Using a non-profit credit counseling agency for a debt management plan. This is a program where you make one monthly payment to the agency, which then distributes it to your creditors according to a negotiated repayment plan. You may get lower interest rates and waived fees through this plan, but you will have to pay a monthly fee to the agency and close your credit card accounts. Applying for a home equity loan or line of credit if you own a home with enough equity. This is a secured loan that uses your home as collateral. You can use it to pay off your high-interest debts and enjoy a lower interest rate and possible tax deductions. However, this option comes with risks, such as closing costs, variable interest rates, and losing your home if you default on the loan. As you can see, there are many ways to lower your interest rate and pay off your debt faster. The best option for you depends on your situation, such as how much debt you have, what type of debt you have, what your credit score is, and how quickly you can pay it off. You should compare the pros and cons of each option and choose the one that suits your needs and goals. By doing so, you can avoid the terrifying 20.69% credit card interest rate and find 0% offers that can help you become debt-free sooner.